All right, we are live. Little different time of the day as usual. I wanted to cover a lot of pain in the market. The bull market is on pause, and here's what kickstarts the next surge. What I think, anyway, from what I see coming out here. Right, we're gonna cover that. I'm gonna give people a little bit of time to step in. We are live right now on YouTube. All right, so let's just do a little technical analysis on what we're seeing right now. Right, so S&P 500, let's go to the daily chart. Take a look at the weekly chart. I think we covered this last time. All the Novembers, right? We talked about these lines. These are the Novembers, how the market usually has a year-end rally. Is it still intact? I think so. The government shutdown's definitely throwing a wrench in the machine. This is not November. This is December. Maybe this is a different chart. That's fine. Let's go SPX. All right, we got 3. Yeah, I mean, we just got started November 7th. Tomorrow, we'd usually get the employment report, but we're not getting that. So we're going to have to go with what we see. All right, so I'm going to give it time. Let's just do a little analysis here. We're still in an uptrend, right? You're still in an uptrend, even though there's a lot of fear. It does feel like we're at a top. Usually you don't get tops until you're really euphoric. I don't think we're there yet. So you can see we're still in an uptrend. Here's that November. See, where did November start? Right here. Okay, usually we should start up November. Well, there is no we should. The market usually performs in November going into year end. And we're going to cover why I think why we recover strong here. Okay, or how we end up recovering strong here. I just want to give a little bit of time. Okay, so we're still in an uptrend. As painful as it feels, we're still, we're still grinding higher. The technicals look bearish in the short term, though. The daily is saying that we still have some more downside. Okay, we still have some more downside. Still have some more downside. We might just retest this 6,500 possibly, right? Who knows? But we're not going to talk about technicals so much today. I really wanted today to cover. Okay, and I just love to see the action in the midday, so we know what we're working with here. Look at all this. We're grinding up right from that sell-off on October 10th. We're really just grinding up this uptrend. Feels painful because you try to break out, you get excited, right? Whatever it is. For you longs out there who are just, holding, we're going to talk about why you shouldn't get so bearish. Okay. Basically, what I see is the financing of the bull market is on pause. Our financing is on pause right now. What does that mean? It means, yes, the bull market is financed through a lot of operations and we lack liquidity. You've probably seen it. There's a lack of liquidity in the market, or liquidity is stalling at the moment, right? We have stalling liquidity, but I think that's going to switch. Look at BTC. Bitcoin cannot go up because of the stall in liquidity, right? Bitcoin is also dropping here. All right, so we're going to get started. We're going to get started now. I'm going to switch screens here. We're just going to talk about this. Come on now. All right, yeah, we got this this is actually going to be in the Discord. I decided to post it here. Just create a little thread. Thought it'd be a little easier to go through. Okay, here we go. All right, so I guess I'm going to talk this way. Let me see. There we go. And then I can click on it, highlight it. Okay, so we're going to start with this chart, right? The U.S. Treasury account. First of all, why is the market lagging? I mean, I'm going to tell you right now, the biggest answer to that lag right now that we're seeing is that there's a lack of liquidity or flows into the banking sector, into markets in general, money market funds, You could say bond markets, currency markets, equity markets, whatever. There's a lack of collateral, lack of liquidity. It's being removed. And this chart really tells us how that's happening. This is the US Treasury general account on the top. On the bottom, we have global liquidity on a year-over-year basis. So it just measures all the money flows, collateral from central banks, um, from the US Treasury at least, and is there an increase or decrease in when the cycle changes. So it's year over year. So we're measuring on a momentum basis. If there's liquidity, you can see liquidity is falling right now. Okay, so it's hard for markets to keep up when there's a lack of that fuel in the market. We want to see that fuel going higher. Are we at the bottom? I don't know. So this is the Treasury general account. The US Treasury has an account, and I have it inverted for some of you who already have seen it before. It's inverted because I wanted to highlight that when the chart goes up, or when the US is injecting liquidity, the US Treasury is injecting liquidity in green, they're spending a bunch of borrowed money, a bunch of debt that they borrowed from the market. They're spending it into the economy some way or another. Okay. And when we have these upside moves, right, then liquidity is, it's called fiscal. I call it fiscal liquidity is coming into the market. It's coming into the economy. So markets go higher, right? There's more spending, stuff happens. And when that account goes down, right, when they're building it up, right now they're building it up, there's a lack of liquidity and it kind of stalls, not everybody, but it does stall things out. So right now they're building, and this is basically money that has to be paid to the, not to be paid, but the reserves or the deposits. They're all moved to the U.S. Treasury from the banking sector. Less collateral, less deposits, less lending. There's all kinds of, witchcraft going on in the financial system. All we really want to know is liquidity rising or not? And liquidity is falling. Okay. But we might be at the bottom. You can see there's not like a support, it's not a stock, but typically I think we're at a trillion. Once you get near a trillion, this is inverted, 1T right here, right? Once you get near a trillion, that's when they start to spend. Okay. This is the pandemic. That's a blip. You don't really want to look at that. But last time we got to around 800 billion, 900 billion. Now we're actually exceeding that. We're around 950 billion dollars that have built up from borrowed money from debt, and interest rates aren't really surging either. So this is actually a good setup, but there's a lack of liquidity. Where's it going to come from? Okay. And that's really the answer. The other part is that's fiscal liquidity from the US Treasury. The Fed is also lagging when it comes to liquidity. They've been tight for a while. So this is US Fed. Well, first, the blue is always going to be the global money supply. Okay. So this is all the liquidity in the world globally. Is it growing up or is it coming down? So it's been in a uptrend for the last 5 years, and it kind of broke out back in late 2024, and markets surged. We had a breakout, and now it's kind of slowing, and the path is still higher. That's the trick here. The path is still higher. We're just on pause. That's it. We're just on pause. And the Fed is actually reducing that liquidity, but they're going to start flipping maybe in 2026, where they start injecting. They haven't injected liquidity since, structurally, they haven't really injected since 2021, right? This is the last time they actually injected. This was just a banking crisis that they had to inject liquidity. So we're going to flip here. You should stay bullish if you're thinking long term. There isn't a crisis happening. You're not going to get a real broad-based recession just because of trade tariffs and all this. There's too much positive flows going into the market, and right now those flows are on pause. All right. So if we look at Japan, and this is just global liquidity in general, Japan is actually draining liquidity. They're tightening rates. I believe they're going to increase rates. So that's a drag on the global economy, mostly for Bitcoin, for US tech. Yeah, because other countries, right? Wealthy people in other countries, they want to own US tech. So Japan's lagging. England, right? The Bank of England, lagging liquidity, right? So they're all dragging on this global flow that bids up, risk assets in general. If you take the not top 5 central banks, so you have China, US, Japan, the Bank of England, and the European Central Bank. Outside of that, liquidity is actually rising. So the rest of the world's actually injecting liquidity, and that's one positive flow or one factor that takes us higher. China, the second biggest economy, is increasing liquidity, right? So China is still pumping like crazy. Not too worried about this market here. All right. Now, the the biggest issue I think we have right now, and I didn't think this was going to be a big issue, is the government shutdown. That's actually keeping liquidity from, or what's actually keeping confidence from investors, because they're like, dude, the longer you keep the government shut down, the more, uh, you know, that the government is not actually spending. So there's 965 billion, probably, who knows, somewhere around there, 900 billion. Let's just call it $1 trillion built up at the Treasury general account, TGA. Okay, this is the Treasury. This is Trump's account to spend into the economy, whatever he wants to do. That there's a lot of money that they built up there. They need to spend it, but the government shut down clogs the rails, clogs the pipes, and delays a lot of that spending. And that's the lack of liquidity. When we talk spending, state and local government spending, infrastructure, construction, transportation, uh, government vendors, there's all kinds of things that they got to spend on that is being delayed at the moment. I'm sure some stuff's going through, but a lot of it's being delayed. Healthcare, human services, agriculture, education, whatever it is, there's a bunch of crap that is being delayed. And this is not going to last forever. We're in the longest government shutdown of all time. Therefore, it's not going to double. Okay. It's going to get resolved. It could be resolved this weekend. That's why I wanted to make this video late, because I'm like, hey, this could get resolved this weekend. Don't get too bared up here. Okay, the technicals, we'll go over the technicals a little bit, but the markets need the government shutdown to end so that fiscal liquidity can return confidence for investors. It's as simple as that, right? Now, that is the fiscal side. The monetary side is in a transition period. So you got to be patient because this liquidity is coming. And I want to highlight here, this is a global money supply. You can see when the Federal Reserve, we have the Fed rates and the Treasury rates. So interest rates in general, or the cost of money in general, when the cost of money in general falls, and yeah, this is the pandemic, but the mechanics are the same. When the cost of money falls, liquidity rises. You can create more loans, you can create more money. When the cost of, and the last time we've had that was, right around here, the last time the cost of money fell, for the Fed at least, and for, the Treasury market's been a little different because we're in a new regime here, right? A lot of debt. Either way, when the Fed lowers rates, their 24-hour bank rates, liquidity surges. So we're still in the liquidity cycle. We're still cycling lower. We're going to look at inflation because this is the structural macro bullish framework where we're still in the early innings of a bull market backed by policy, which is they're going to keep printing, right? They're going to keep cutting. We're just on a delay at the moment. So that's going to come regardless. You just got to be patient at this point, at this juncture, we got to be patient. So because, one of the reasons that this is inflation. One of the reasons that the market is tripping out because Powell in his last cut kind of turned hawkish and said, well, we don't know if we're cutting in December. Well, if there's a panic, people are panicking on the labor market. Well, he's going to cut. Okay. He is just delaying because there's not enough data. We're in a data freeze. So it's kind of uncertainty. Uncertainty is a drag on the market. It's not just lack of liquidity. It's uncertainty on when that liquidity is coming. If they delay for too long, then that's when you get blowups in the banking sector. The real estate sector looks bad. You get some blowups. Small cap companies really can't handle it. So either way, if you look at inflation, they're going to be cutting. People are also like, oh, well, look at inflation. If inflation continues to rise, which we're not even getting the data yet, then rates rise and the cycle's over. We're going into a 10% correction. Okay. If inflation goes up, we're going to hit a correction because the employment market is falling and the Fed can't cut. Right. If inflation is cycling back down and we're just in these little bump up periods, right? Bump up, everyone's like, oh, inflation's back. You know how many of these dudes have told you guys inflation's coming back just because it bumps up and it comes lower? They keep saying it and it rolls over. We're just going to roll over again. Okay. Especially with the labor market and consumers hitting a wall with spending, or the amount of the acceleration of spending, they're hitting a wall. Trust me, it's coming lower. Okay. I don't care about electricity costs. I mean, people are not, if they don't have a job or if they're not spending, they're not spending. So this is the debt reset that we're going to get. And as soon as inflation rolls over, the debt resets. When I say reset, rates have to come lower, like we looked here, right? As rates come lower, debt that's out there gets reset in a matter where it's like refinancing, right? You owe 100,000 on your house and you're paying an extra, 1,000 a month, let's say, on interest. Well, as long as these rates come lower, you can refi. Now you're paying 500. That's an injection of liquidity into markets. So the market just wants the Fed to cut, and it needs the government shutdown to end. So there's liquidity from the Treasury side, from the fiscal side, and so there's liquidity from the Fed side or from the market side. And we're going to get that. Okay. One of the structural issues also is that the Fed's rates are too high compared to the US two-year Treasury rate. The Treasury rate tries to copy the Fed. This is borrowing for 2 years. This is the market lending, for a 2-year rate. You don't want, so banks are the ones borrowing at the Fed, not us. The banks borrow at the Fed, and if the Fed rates are higher, they're borrowing at a higher rate than they're lending or that they're receiving from the US Treasury Department. So banks, what do? The banks are the ones who run everything. They know what's happening. They see consumer spending, they see CapEx, they understand, which companies owe what to what degree, who's underwater. So the banking sector is very important. And if the banks are borrowing at, let's say, 4%, and then they're receiving, they're the banks are they're not the primary lender, but we're lending to the government. They collect a rate, right? They have to be profitable to some degree. You don't want the banks to be unprofitable. So they're actually receiving interest lower than they're borrowing. That's a 0.04. This is just an example, 0.04 spread. That means that they cannot finance a lot of loans because they're kind of underwater, or they're not loose. They're not loose enough. Okay. So we want the Fed eventually to get below that 2-year rate. This causes panic. We're headed there, but it does cause, a lack of confidence in risk assets, which is fair enough. I mean, risk assets went crazy. Like, there's a lot of companies that are up with no earnings, but this doesn't mean the bull market is over. It just means there's a pause in confidence. That's it. There's a pause in confidence. And as Jerome Powell moves closer to being dovish, he's going to have to now with all these reports. Actually, these reports are good. The panic in the, citizens, or whatever you want to call it, the panic in the baby boomers saying, oh my gosh, recession, employment's blowing up. That's going to push the Fed to be more dovish. They're going to come out. They're going to say, yeah, we're going to be cutting, right? They're going to talk about inflation, but they're going to cut. They're going to have to cut. And that's what the market wants to hear. I guarantee you a deal is going to be done in the Treasury. We're going to get that passage of the shutdown soon. I'm not worried about that. Okay. So we'll come back to this. Anyways, the next thing here is there's a lack of financing. Okay. And, there's a lack of financing from the Fed. Well, the Fed is financing the bull market, but they're using language that pulls it back. Well, the government shutdown is stalling liquidity from the fiscal side. The next, liquidity is from corporations. We're talking corporate liquidity. This is capital expenditure, CapEx. We know the hyperscalers, which we're going to hit, are spending, but the rest of the non-AI CapEx companies, they're nervous. Right? They're nervous, and we know it because we look at the ISM. This is the manufacturing cycle, the capital intensive stuff, right? Buying big things that are going to be financed because you can't buy it all at once. Homes are financed, right? Those are big purchases. And we're still in recession. This is the longest recession in history for the ISM because tariffs are weighing. Trump thought tariffs would build manufacturing, which it is in some degree, but it's also lowering confidence. It's keeping them from saying, well, we're going to make a big purchase because they don't want to fail. So they're being conservative, right? They're waiting for the gut punch. Oh, is this going to hurt? But they want the Fed to cut too. And the Fed's all, oh, we might not cut in December. So businesses are like, damn, bro, we have no confidence. As soon as we get above that midline, it's game over. The market's going to reaccelerate again. That might not come till January now. I thought it would come earlier, but we might be pushed back. It's stalled, right? Liquidity is stalled. If the government shutdown ends, we have some more confidence. We might get that ISM pick up. And this is the manufacturing ISM. We'll see, right? Now, this is dire for a lot of businesses, right? The market is wishy-washy. It needs the Fed rate cuts because real estate's really in trouble, okay? And I don't mean like global recession. No, real estate individuals they're making it, but it's not a strong market for sure. Okay, so business confidence is in the longest recession in history. They need rate cuts, and the Fed's being stingy. Tariff uncertainty is weighing on them. Rates are still elevated in a sense where the Fed rates need to be lower. They're elevated for bank lending, so that's constraining things. And if we look at real estate and construction jobs, well, if pending home sales are just flat, right, historically flat, down to pandemic levels, building permits, so these are permits to build, are plunging, then you're not going to get a whole lot of construction hiring. Now, in some areas in the US, yes, but for the most part, the macro view is employment is rolling over, and the Fed knows this. They're going to have to cut. Real estate loans, they bottomed out, right? Barely. They've been dropping for a while. Real estate loans are going to be picking back up because the Fed is cutting. They've been cutting, but the 10-year is stuck. Either way, um, we're at the beginning of the cycle. These loans are barely starting to pick up. So we're still early. This is actually positive, for the long term, but in the short term, there could be some slips. With the VIX over 20, we could have a nasty correction in certain stocks, certain sectors, certain industries can really get hit hard. So you want to wait for the VIX to drop back below 20, at least I do. Or you could top ticket when it goes crazy to like 28, 30. We'll see. We top ticked it last time. We didn't top ticket. We just said, hey, 28 is the top, unless we get further, uncertainty. Same thing here. Housing, look at real estate sucks and it's hurting jobs. Here's the employment that we're supposed to get the data tomorrow. Employment is near zero. We're almost negative. So the market really is like, bro, you guys need to cut. We need to chill out with the tariffs. Okay. And we're not political here. We're just saying chill out with the tariffs, make some trade deals, because we can't keep spending our, there's not enough jobs. We're at a point where we don't have enough confidence to just start expanding business unless you're, hyperscaler, AI, CapEx, plus there's a bubble in LLMs. So, power generation's the only companies that are really making a lot of money for no reason. Everyone else is just making shit up, right? A lot of them are making shit up, unless you're the companies we're going to talk about at the very end of the stream. Okay, so employment sucks. The Fed needs to cut. The government shutdown needs to end so they can print more money. Where the fiscal, Trump or the administration can start spending whatever they're going to do, defense, blah blah blah. Right. So the non-AI economy is already in a recession. We've heard it 1,000 times. That is true, but the bull market's not over because of that. The Fed just needs to act fast or quick, unless in case something blows up. But they're going to do it. They did it last time, the banking crisis. We might have another one. They did it last time. They injected liquidity. Bitcoin went crazy and the bull market restarted. So we'll see. We might just have a clip. Let's go to the upside. That's a bunch of bear news. Oh my gosh, we're going to collapse. They're not going to let it happen. They can't. There's too much debt in the system. They have to reset the debt. But they can't just tell you, because then, inflation might rise or people might go stupid and take too much risk. So they got to be careful with their words. Here's the upside. Number one, the government shutdown. Okay. Can I zoom in or no? The government shutdown resolution is easy. It's an easy solve. These fools just need to stop acting stupid and solve the damn shutdown. They'll do it. Okay. It's not like a structural issue. It's just get your pride out of the way. Whatever. You guys already know, right? Dovish Fed speak will lift corporate confidence. I guarantee you they're going to turn dovish. They have to. So that's going to bolster corporate confidence to some degree. It's not just enough speak. It's just like we need the combination of government shutdown over, fiscal liquidity back, Fed back to dovish tone, right? That's what we need. So yeah, stocks are also not in a bubble yet. I know bubble. No, LLMs are in a bubble, not stocks. Historically, these bubbles that popped, like the housing bubble in 2005, big part of GDP, big, how do I say this? They were a large section they're at the end of the run. They were so big in terms of GDP that it was poppable, right? It was, it got so inflated as a share of GDP or nominal GDP that it was sensitive. We're not even there yet. We're not that sensitive. .com, huge, 4.25% of GDP. This is a bunch of investment so big. Railroad spending in the 18, whatever, historically, we're still low. We're at AI investment is only 1.3% as of 2025 of GDP. I'm not worried about a bubble yet. When it gets way up there, then we can worry about a bubble. We're not there yet. Plus the companies make, hundreds of billions of dollars. And we're going to cover that next. Also, jobs. Oh my God, they're disappearing. Well, historically in yellow, in blue are basically jobs that existed in 1940, right? Barely. Yellow is jobs that didn't exist. So what it shows us here historically, you can go look at the research, David, just take a screenshot, whatever. Historically, we end up creating the same or if not more jobs or somewhere around there over time, right? Technology creates different jobs. There's a transition period. We're in the middle of that transition period. So if you're a job seeker, that sucks unless you have the skills. But if you're talking about markets, markets don't give a damn. As long as there's liquidity and technology solving problems, the market's moving higher. How about PE ratios? Oh my God, the PE is so high. Historically, look at our PE ratio, right? Price to earnings, meaning are prices inflated versus earnings? No, they're not. Way bigger back here in 2002, 2008, 2021. There was way more price per earning. Today, we're moving up, but we just had earnings. As a matter of fact, earnings are good, right? Earnings are solid. Earnings growth. Let me read it so I don't forget. Earnings growth and price corrections, reset valuation. So earnings growth, which we're starting to get right now, we're getting a lot of earnings growth. That's going to reset the PE, right? Because more earnings means, the PE lowers. And then price is we're getting a correction right now, a small correction. Well, that's going to lower the PE. Then people are like, oh yeah, valuations are not that bad, right? Over the last 4 reports, I don't even remember what this is. Hold on. Growth. What are we talking here? 4 quarters. Yeah, last 4 quarters. Oh, here we go. We've been in double digits. So we are slowing, double digits slow, but the last 4 quarters of earnings have been above this line right here, have been double. This was the recession. This was the earnings recession. Then we came out of the recession. Now we're double digits. We're in double digits. So the market is strong and you have a lot more growth to go. As a matter of fact, this year, after the hyperscalers reported, before they reported, we're expecting 7.9 or 7 point something percent, 7 point something percent earnings growth. And after they reported, boom, we jumped to 10%. So we're beating. The whole point is, oh, well, it's a bubble. Dude, there's a lot of earnings growth here. Things look great. I like a lot of companies that I'm seeing here. Once the dust settles, I'm like, oh yeah, these look really good. Okay. Going into next year, how about CapEx? So listen, the Fed's going to be cutting. They're going to increase liquidity. They're going to expand their balance sheet. The U.S. Treasury has almost $1 trillion of fiscal spending that they're going to unload going into next year. So that's monetary liquidity, fiscal liquidity, and then here we got CapEx liquidity from 4 different companies. They're spending almost 500 billion from Amazon, Microsoft, Google, Meta, almost 500 billion of CapEx towards AI capacity, right? They're building their capacity for AI, more computing, more chips, they're spending so much money. What do you think is going to happen? You really think we're going into a bear market? We're not. If valuations were super stretched, yes. Oklo just got cut in half. SMR cut in half. So we're not at that bubble poppage yet. We're still climbing, right? Things are getting cut. We're rotating. Here's the earnings guidance as of today. Earnings as of this week. Earnings guidance going into 2026. Q4, which is probably what we're next earnings, we're supposed to go down in earnings. So this could be the pricing in of the next earnings report. Like, oh man, earnings are going to be lower. We're here. Okay, we're here. We're still double digits. We should slip below double digits according to estimates. And then from there, we just go higher the whole year, all the way through 2026. So I wouldn't be bearish until Q3 2026, right? I'd be bearish when you're going up. The fact that we're going down, that we know earnings are going to be lower, the market is literally pricing that in right now. And looking at rates, there's so many other things. Rates are going to be down. They're going to price it right back in. It's when you're exuberant. It's when earnings are crazy when you got to be careful. But right now, we're not there. So the takeaway from all this is that AI capacity continues to rise. Cloud revenue, and matter of fact, it's not just the build out and the promise to spend more. AI revenue is literally rising, right? No recession in sight. No recession in sight. Now, yes, the ISM in blue, manufacturing has been in recession, and non-AI companies are like, oh my gosh. But the services side expanded yesterday. That's why I'm not worried. We're not plunging into recession. ISM services or business cycle service side, which isn't the cyclical, it's not the super risk assets that really care about that. This is just stabilization, right? This like Lemonade Insurance, right? Lemonade blew up. It's going higher. That's a service. They have to purchase things in the economy to run their digital service, and those purchases are up. So I'm not worried about it, right? Now, if the economy is really going into recession, which this is good, credit spreads would be blowing out like they did here. Okay, this was the tariff, the April tariff. Like I said, hey, if we get above this level, what was this? I don't even know what this is. I think this was the summer. Yeah, this was the Nvidia earnings summer where credit spreads blew up because GDP, something slipped and there was a growth scare here. And then credit spreads blew up again during the April tariffs when Trump did the what is it? I don't even remember what it was called. Whatever he called it in April. That was crazy, right? And that was the credit spreads. Credit spreads are not even blowing up right now. I'm not worried. We're not worried. When those credit spreads blow up, then we can say, okay, whoa, what's going on here? We're not there yet. So ultimately, right? Ultimately, I'm just going to read this out. Liquidity is just stalling. Okay. And the Fed is still cutting. The cutting cycle is still early. What do I got here? Fed rates are heading lower. Yeah, the Fed is heading lower with interest rates. They're still heading lower, regardless if they do it or not. So that's a tailwind. The balance sheet expansion is going to start turning on next year. So they're going to start actually buying back treasuries, or in other words, injecting pure liquidity into markets. Okay, you're almost hoping for a collapse in a bank or a real estate firm because we're invested in tech. We don't care unless you are. I'm sorry, but balance sheet expansion for the Fed is going to inject more liquidity. So the market's already looking into that. The TGA, the Treasury General Account, has $1 trillion of liquidity. They just need to open the government so they can start talking about how they're going to spend it. And I'm just, using simple terms here. CapEx liquidity is rising over 500 billion from 4 companies next year. Oh my God, there's so much money being generated. Stop worrying about recession. Okay. There's new jobs that will get created. That's how it always is. We're in a transition period. There's a lot of opportunities. The biggest drag right now that I see is the ISM cycle hasn't turned positive yet. Once we get above 50 and we expand, then we're positive. And at the end of the day, I already talked about that. At the end of the day, we're this is the biggest impending threat. They need to spend the 960 billion on all this stuff: infrastructure, state, local government, private sector contracts. We need that money spent. The government needs to open. That's going to be a good catalyst. I know people are going to say, "Oh my God, it's not that simple." No, when the government shutdown ends, the market's going to catch a tailwind, unless the Fed comes out and says, "Oh no, we're not going to increase rates, or we're not going to cut rates." They will. Now let's talk about a couple charts here. Okay, strong beats. So real quick, wrap up. Fiscal liquidity. Okay. Government shutdown, monetary liquidity. That's easy. That's coming no matter what. And then you have CapEx liquidity that's coming no matter what. So there's no reason to really panic. There's no reason to panic. Let's talk about strong earnings here. Lemonade, Datadog, Xometry. Okay, we've talked about these for a while. I'm going to now put this to the side. I'm just going to pull out charts. Well, not that you guys can see that, but let me pull some charts out here. And I don't want to stay too long. I gotta get back to my routine, but I wanted to just reassure you guys who do watch, hey, look, don't panic. Do not panic. Yes, crypto's rolling over. It's retesting. Oh, great. Crypto retraced 20%, right? The bull market is not over for crypto because the liquidity cycle is not over. It's just that liquidity stalling, literally M2. We showed this the other day. Talked about this the other day. Global, here it is. Is this it? Yeah, here we go. Global M2. Look at Bitcoin at M2. Bitcoin's a liquidity sucker. So monetary, like global liquidity in blue, we retraced all the way back to where we were in June. Well, look at Bitcoin. It retraced all the way back to where it was in June. Pretty simple. You just want liquidity to go back up. A lot of this is the TGA sucking liquidity out of the banking sector. Why? Because the banks have to buy treasuries or buy the treasury issuance from the government. They have to buy that debt so that they can turn around and spend it back into the economy. And that's all we're waiting for, right? That's all we're waiting for. All right. So a couple charts here. We're not going to go crazy. Who beat strong on earnings? Lemonade Insurance. They beat. Let's take a view back. Okay. We're not going to stay here. I'm not doing a bunch of people's charts today. I got to go. Just wanted to point this out. Okay. This is a bullish chart, very bullish chart. As a matter of fact, let's go to the weekly. As a matter of fact, it's insurance. So it's sort of bullish. Even if you go into recession, it's still bullish. I don't want to say recession, but a slowdown, still bullish. If inflation goes up, still bullish. Why? Because you're going to be paying these inflated prices. This is a very beautiful chart. It's breaking out. What am I looking for? Okay. All I'm saying is this, oh, we don't need to look at momentum. This is the all-time high. Okay. As long as it consolidates above 65, well, not consolidates, anything pushing into this level. Okay. I want to see a push back into this level. I would love for it to come back to 60 and bounce. Boom. Simple as that. Come back into 60 and bounce. Next stock, Datadog, crushed earnings. Okay, we'll talk about the earnings later. I'm going to post it in the Discord, the actual, positive relevance here. Datadog, what do they do? You guys already know Lemonade Insurance. They're using AI. Datadog this is a beast. This is a $50 billion market cap. I think it could be 250 billion. I think I could do a 5x. It's not a 10x, 5x. But either way, Datadog is cloud monitoring. So think of it as cybersecurity. This is a big, cybersecurity is huge. I know there's CrowdStrike and there's Palo Alto Networks and there's Sentinel One and there's all these Fortinet. This one's better. I don't want to say better than CrowdStrike, but it's hard for me to explain. It's data monitoring. So any kind of cloud infrastructure, it's like a watchdog. Like, I don't know how to explain it. I'm not that smart. Let me just go to the earnings really quick. Maybe this will be better. I know there's like different ways to say it. And they're almost at $1 billion a quarter revenue. Rapid growth smart platform adoption continued to I just call it software security. Platform adoption continued to increase 84 forward guidance, blah blah blah. I know I think they acquired somebody. So this is a platform though. The whole point is it's a platform, so everybody uses it. Almost everybody, if you talk to a software engineer, almost everybody uses Datadog. Okay, they just had a high valuation. Let's look at the breakout. Very high valuation. I thought I'd come in here and know how to explain the company. Can't do it yet. But look at that big wedge. This is going to explode. Okay, I think it's going to 250 first, and then 400. Right? When, I don't know. We're waiting for liquidity to come back into markets, but Datadog is definite. It's a need for all markets. Oh, here we go. Agentic AI. All the AI agents that are being built across different software companies, all these tech stacks, almost all of them are going to need cybersecurity within the agents. This is what Datadog provides. In simple terms, they provide security, cybersecurity, and it's kind of workflow automation. It's not really automation. They do workflow. Like, I'll just look it up really quick. This one's so hard to explain. I don't know. I'm not a tech guy. Oh, here we go. Datadog surpassed 1,000 integrations on its unified platform. Everybody they're plugging in data. They have a lot of adoption. Okay. It's a platform. So it's like Palantir. It's a platform that everybody has to use, not necessarily you integrate it. You're already building on top. Okay, I can't explain it. Anyways, let's go to the explanation. All right. So Datadog engages in the development of monitoring and analytics platform for developers, information technology, operation teams, and business users. This platform integrates and automates infrastructure. So it's an infrastructure. There we go. It's an infrastructure. It's needed, right? You need this infrastructure to run AI agents. That's why I'm bullish. This platform integrates and automates infrastructure monitoring, application performance monitoring. So they're monitoring for cyber threats. They're monitoring for dysfunction. And it's a monitoring security infrastructure, log management, blah, blah, blah. That's all you need to know, right? For now. There's just too many good companies out there. Anyways, Datadog's that next one. All right. And then we have Xometry. This one needs the ISM to pick up, but they crushed earnings. And these are in this bear market pullback, right? Where everybody's all bearish. These are just companies that are actually breaking out during their earnings. If they're breaking out during earnings while the market's rolling over, it's a strong company. Okay. So I think this is going to be a 10 bagger though. I think this is a 10 bagger. It's consolidating. We'll see. This is not a quick trade, high risk. This is a developing long-term hold company. Okay. So Xometry, what do? They have a big network of suppliers. So if Trump is bringing manufacturing back to the US, that means there's going to be a whole lot of parts. They actually not only provide 3D printing, but They have these mobile areas all over the globe, and they use an AI marketplace a lot like Amazon. You know, Amazon, you go in the marketplace, you go buy and sell, like, oh, I need to buy this, I need to get groceries, I need to get you know, performance enhancers, I need to get you know, something for coffee, I need to go buy. They do the same thing for all manufacturing. So it's digital manufacturing platform, an AI digital manufacturing platform. It's getting bigger. Go look at their earnings. They're crushing it. And they just need to they're not profitable yet, but they're going to get there. They're growing rapidly. And with the ISM expanding, they're going to have so much. And they have the biggest supplier network, I believe, in the US. So this is a monopoly. Them and Datadog are ahead of everybody else. Okay. That's why I point them out. So Lemonade, Datadog, Xometry. Now, this one is not enough electricity. Okay. This is the next theme here. TeraWulf. TeraWulf has one of the biggest data center compute facilities next to Iron. Okay. They're actually better than Iron in some capacity. Fluid Stack is using them. This is Google's Fluid Stack. Google has a big stake in them. And this one's overbought. It's really overbought. I talked about it the other day. Super overbought. But look at Iron. The thing just kept going. Oklo kept going. So keep your eye on their earnings. They're coming up pretty soon. When is the earnings for this? And why is it not on here? God, I don't know how many times I put this on here. So they have earnings coming out pretty soon. I think it might literally just take a leg higher. It's possible it gaps up. I hope it doesn't. I want to see a pullback, but this thing could run. Either way, they're providing electricity. And the theme here is that there's not enough electricity. There's only so many companies who generate electricity. They use hydro and nuclear, okay, where Iron uses hydro and wind, I believe. They use hydro and nuclear. Nuclear facilities are getting better, regulations coming down. So this could be a big, I think this is a 10x, right? From $10 is when we talked about it. So I think it's a $100 stock. Maybe next year, maybe 2027. I don't know. Either way, I think this is a big winner here. Keep your eye on it. I'm not saying buy it. I'm not saying invest in it. Keep your eye on it. I like it as an investment. Another power generator, which is more grid stability, Fluence Energy. JP Morgan initiated a big buy on Fluence. They've been consolidating for a long time. Okay, they next to Tesla, this is why I'm big on them. Tesla's the biggest energy storage provider in the world, next to BYD. Fluence is a small cap company that is next to Tesla. So they're stabilizing the grid, and that's the only way you're going to. Now you have power generation, TeraWulf, Iron, Hut, all these companies generating, but how do you store the energy? You need battery storage technology, right? And we're not talking about for EVs, we're talking about for the grid. So I'm big on this. I don't know when it breaks out. We'll listen to the earnings. I'm just throwing it out there, right? Next, we have pullbacks. RKLB, Rocket Labs, have been waiting for this forever. Okay, it's up so much. And we're finally getting a pullback on Rocket Labs. Okay, this is for the long portfolio. You're getting a pullback finally. It's almost there. I'm just keeping my eye on it. Okay, it's coming back. Ooh, I love it. Right, it got up to 90. They're competing with who? SpaceX. They got up to 75. Now they're back to 50. So they're in this consolidatory period, right? Phase. I like it. Okay, Rocket Labs, aerospace, a lot of defense spending. And a lot of these drone companies also got crushed because of the defense spending. We don't know where it's coming. We don't know, between the left and the right, or the Democrat or the Republicans or the Democrats. We don't know how much. Yes, ASTS is literally the next one, bro. Literally the next one. It's Rocket Labs and ASTS. Those are the two pullbacks right there. Well, no, there's one more. But these are the two big pullbacks that I think you get leap calls or you buy shares. Okay, not financial advice. I'm not telling you what to do, but these are growing businesses with a long-term moat. They have a moat. They're still higher risk, but in this macro environment where all these trillions of dollars are getting spent, I'm telling you, you want to be long these stocks. Beautiful chart, by the way. So Rocket Labs and Space Mobile. And we're not going to go deep into the fundamentals yet. That's going to be on my Discord. All right. I'll post the earnings, the moats, the competitive advantages, all that on the Discord. So ASTS, right? Great pullback. When do you get in? I don't know. I mean, we're not ready yet. We're still navigating this macro pullback. Either way, look at when it gets oversold on the daily, could be a buying opportunity. Okay. It's pulling into a previous resistance. We'll see. there's a clear break of trend. Who knows? So Rocket Labs, ASTS, these are dip buys, okay, that are already in super momentum, that are being adopted. And then you have Tempest AI. They crushed earnings. They were up like 80% year over year. This is a must-have. This is not agentic. This is AI in genomics. So we're talking gene editing, or genes, whatever you want to call it, genomics, gene editing, whatever. They're using AI to build these different platforms for oncology. What does that mean? I don't know. I'm not that smart. Either way, what it means is this is the next generation of medicine and healthcare. And they're going to figure out how to cure cancer, not them specifically, but with their data analytics, they're figuring out how to cure things, how different stuff works with AI. So this is a lot of opportunity. It is higher risk. It sold off and they crushed earnings. They crushed earnings and sold off. Okay. Surprise to the upside. I'm going to be posting a lot of their earnings reports on the Discord. So, you know, these top companies, what they're actually providing, what are their moats and all that stuff. So anyways, Tempest AI almost breaking out of a very long-term trend. I mean, it's been here since what, 2024. I mean, it's a new company, but this has a lot of potential, right? Next, robotics. Let's go to robotics, because this one is a theme that's been rising, right? Symbotic, we haven't really got to buy, hasn't pulled back enough, but we're starting to get it for Symbotics. Let me go to should I go to the weekly? Look at that chart. Beautiful chart. Okay. We talked about it when it first broke out and it just kept going. So we haven't really talked about it, but now we're starting to get some weakness. You're getting a little bit of rollover. I think it consolidates I think they should go down on earnings because their valuation is very high, but this is a very strong theme, which is, you've guys heard of Teradyne, right? Teradyne talked about inventory manufacturing, or robotic inventory is taking over. That's a big thing that they're testing, whatever Teradyne does. They're in that industry. So Symbotic, I think they acquired Walmart something. So anyways, they have a lot of good stuff going for them. I like Symbotic, but maybe some more consolidation. Just keep your eye on it. A lot of these companies tank. A lot of small caps that some of you guys have pointed out, they got crushed like 40-50%. That's why I say when there is a correction, I'm only trading those. I'm not trying to get really long those unless liquidity flows are picking up, unless the technicals are really nice, because they can overnight cut 20%. Symbotic's not going to do that. All right. So we got Symbotic here. Qualcomm crushed earnings, but they are very ambitious. Okay. They pay a dividend. So they're a very unique tech company. They pay a dividend. 80% of their revenue is in mobile phone chips, but they're also expanding into robotics. They're acquiring some robotic companies to build who knows what kind of robots they're designing. So we're still early, high risk, but big, they're going into inference. They're competing with inference, which is a $7 trillion market. Inference as in, you have compute, you have AI compute, you have chips, you have training, right? Trainium, Amazon has Trainium, NVIDIA trains chips, and they're going into inference, which I'm not going to go into. I'm not that smart, but I've heard people talk about it. And inference is a huge market. Go ahead and look it up, because we're talking about charts here. Look at these beautiful charts. Qualcomm has a beautiful chart. When this thing breaks, it's going to move. Need some time, right? But it's a good company, great, solid company. I would own it. I would definitely own it. I think this is a compounder. Next, we have Tesla, who enough said, right? We all hear about Tesla every day. Tesla's about to break out of a long trend. I think it's going to 800. Okay. I think it's going to 800. They're going to make some announcements. The Fed, as soon as the government shutdown stop, there's too much here. I just want to say Tesla, another big buy, right? Now the ones who are very high risk, if there's no recession, I'm going to buy these dips. Okay. These are getting crushed. Let's go to the daily so you can really see how bad they're getting crushed. Look at Oklo. It's almost halfway, so it's almost there. But Oklo, big head and shoulders. Okay. Remember, it did a head and shoulders last time. And I thought, oh yeah, this thing's going to get crushed. And it just, here's the head and shoulders. I think it was like right here. It was small, but it went from 70 down to what, 60. It didn't fall that far. I think we're just still in the uptrend. What is this? Oh, I had it on a different style of chart. That's why. So Oklo, I'm looking for something around. I would love for it to drop under 100. Under 100 for sure. Okay. Oklo is falling like a rock. SMR under 30. These are nuclear plays. Oklo is ahead of everybody else. They're not making money. It's high risk. You need lower rates. You need exuberance. You need But the theme is power generation, right? If they're going to be generating power, then the stock is going to go higher. It's going to bounce. Um, Small modular reactors. SMR is the only company, or NuScale is the only company who has a U.S. patent or U.S. regulation. Blah blah blah. Again, there's too much data for me to remember. I can't remember all these things, but I look into them. I'm going to be posting them under fundamentals on the Discord, so you'll see. SMR, something I want to own. Nano nuclear, another. These are the 3 nuclear high risk plays that I'm interested in. Nano nuclear, I exited a lot of my position. Big head and shoulders, but it's okay. I want to see it get crushed. I want to buy it in the 30s, right? I want to buy it in the 30s. So nano nuclear, that's another one. Those are all. That's what I wanted to point out. That's all I have for you guys tonight. I got to get. Well, it's already 6 my time. I know it's like 9. It's like what, 8 p.m. But I got to get back to my routine. I just wanted to point this stuff out. Have you covered broader markets like QQQ yet? Might have missed it. Curious about your retracement targets. No, I'm not. I don't really. I haven't really looked at QQQ, to be honest with you. I can give a quick little synopsis here. It's still in the uptrend, right? What I do if I'm looking at the index is I'm going to use the anchored VWAP to see where it could, possibly come down to. But I look at momentum. Usually it bounces here at this midpoint for the daily. So it's in the bounce period. I mean, we could literally bounce government shutdown where, that's it. This could be it. This was the previous high, right? What, 610, 611, 610, whatever. Looks great. Filled the gap, right? QQQ just filled the gap. If it does slip, then I'm going to say, because I think it already dropped this level. I think this is the strongest level, 610. If it does continue to slip, which I'm watching the VIX, that's what we started with the VIX. I'm just looking at the VIX. If the VIX gets above 20, then I'm looking deeper, right? I'm looking at deeper levels down to 602, but I don't really trade Qs. I just use it to look at. So no, not really. On the weekly chart, I did flag this though, where, later down the road, the momentum is waning. It can't stay up here forever. So I think we peak out if this bull market continues. I think it peaks out early next year, Q1. That's when earnings really start to fall. So I'm surprised a little bit. I think a lot of this is government shutdown, lack of TGA spending. That's the biggest outcome I have here. But look at this. Yeah, it could stay up here for a while, but the Qs are still in an uptrend. They're still strong. I'm not worried about the Qs. They're still strong. If it does have a monster pullback for some reason, then maybe you're looking at like 570, somewhere around this area, right? But for now, I'm not too worried about the Qs. I'm going to leave you guys with this. I'm going to leave you guys with this. Okay. VIX, this is literally it. I'm just watching the VIX. You can't watch every stock at the same time. So I'm looking at the VIX. Okay. The VIX above 20, panic. Below 20, we're good. So far, so good. We've got rejected 3 times. Okay. On the VIX, 1, 2, 3. At that 20 level. Oops. We've got rejected 3 times. It doesn't matter. We could just, blow up tomorrow. If so, I'm waiting. I'm not going to go try to buy the VIX while it's going up. I'll wait all the way till it gets to 28. We called this level last time it blew up. We said, if it starts to support, we're not ready yet. We're not ready yet. Wait for it to go to 28. Boom, went to 28. That's the second standard deviation. All right. Or no, that's the first standard deviation, which is out of the norm. So I think if we break out, we're going back to 28. If we break 28, we're going high, but we're not there yet. I don't see anything too vicious to get us there. I already forgot why we went here, right? Maybe just too much stocks, but earnings are solid, right? So I'm keeping my eye on the VIX. If we get rejected for a third time, it looks like it wants to move up. It looks like it wants to break out. I'll be honest with you, just getting the feeling of the market. It should have got slammed and stayed down, and it looks like it wants to bull up. So look for VIX 28 over the next week or two. And when you see that hard rejection up here, that's where you want to look to get long. Are we going to get below 20 and hold? Maybe, but you see, like last time we got below 20 and we flirted with it, and that wasn't good. You want to see it get slammed. Like we had a good slam here, but then it just came right back up, slammed again. I was like, oh yeah, we're good. And then we start to, to move up again. And this was tariff news, right? This was possible tariff China. What are we going to get here? This is literally just the stupid shutdown backing things up. So we're good to go. Look, the shutdown's over. Here comes $1 trillion of fiscal liquidity planned and spread out throughout the economy. Yes, employment is slowing, but there's new jobs created. And trust me, these companies are going to do what? They're going to expand. They're not getting rid of all employees. They're tightening up because this is the cycle. They're just tightening up. They're going to keep expanding their CapEx. There's so much money in the system. Government is going to create new jobs. There's going to be new jobs. They're just going to be different. You have to shed. It's not like you can create. You can't cut a job and create a job at the same time and be efficient. You have to cut and say, what do we actually need? All right, how do we expand? The market is looking for, how do we beat out China? How do we beat out China in this AI race? This is critical for US dominance. How do we beat out China? We need to create jobs that actually produce something, not just sit there and, you're just, I'm not going to say it. You need jobs that actually produce something. That's what we're aiming for. The market's going to go up. The Fed's going to cut rates. Liquidity is going to rise again. CapEx is expanding. This is a pullback. Watch the VIX get crushed under 28. That's all I got to say. Stay blessed. I'll catch you guys next time. I'll probably do a stream tomorrow, actually. All right. We'll look at some more technicals. We'll see how things play out. Anyways, you guys stay blessed. Take it easy. We'll catch you next time.